Hello everyone, thank you very much for joining me for today's snapshot, and today is Non-Farm Payroll Friday and we're going to be looking at that and how to trade it. But before I do, please take note of the following information. Please know that CFDs are high risk products and you should be aware of the risks that they pose. Also, please realize that this is general market commentary only and does not constitute investment advice. And lastly, here are our sources. Okay, thank you very much for that. Let's get into it. So the non-farm payroll is due to be released at 8:30 a.m. New York time, so just over an hour from now. The unemployment forecast is set to come in at 10.5%, which is an improvement from last month's print of 11.1%. And the non-farm employment change is forecast to increase by 1.530 as opposed to 4.8 million last month. And we want to keep an eye on the average hourly earnings, which is still forecast to be deflationary at minus 0.5%. However, that is still significantly better than last month's minus 1.2%. So the deflationary forces are expected to be coming in at a decreasing rate, and we want to see if that is the trend that continues. Let's take a look at the S&P 500 ahead of the announcement. So what I'd like to do is draw attention to two levels on the chart. So the first level, we're going to put in support over here, and let's make this green. And let's put in some resistance over here. We'll make that one red. Alrighty, and let's just adjust it so it's looking a little, there we go. Now clearly we're above the overhead resistance. Any sort of pullback to this point, we would expect that resistance to have turned into underlying support. And I think this is tremendously important, especially when we're talking about non-farm payrolls. And the reason for that is the unlimited QE program has moved a mass amount of liquidity into the market, and that liquidity is finding a home. So the support that we have here, this is all liquidity based, right? So we've got liquidity over here, which would be from the Fed. There is some issues for the overhead resistance. Right now, we'll just put in geopolitical, okay, with the China geopolitical with the China-US escalation. I'm not getting the spelling quite right. There we go. Okay, but it's not only that. There's excesses. Okay, there's excesses in the market. The market tends to be overvalued. We can see the growth market has PE ratios that are ridiculously expensive. But more than that, the gold market is dear, the silver market is dear, the dollar market is oversold to the downside. What we would expect is that if the non-farm payroll misses and it causes a risk-off movement, the liquidity over here comes in to support the market, meaning that a dip is compelling. If the non-farm payroll hits, well then I think that satisfies the market because the fundamentals are off kilter now. The market's desperate for some sort of fundamental basis to move forward. Let's end off with some key takeaways. Okay, so the market seems disconnected from the fundamentals. Sorry, there should be an extra E there. Liquidity is the order of the day. The market is desperate for some fundamental catch-up. However, there is underlying support which is compelling, specifically because liquidity is the order of the day. I hope that you enjoyed the snapshot. If you did, please click the subscribe button below, and I look forward to speaking with you in the near future.